How goes it all? Welcome back to Patterson on Properties. Hopefully you guys are having a great and exceptional day. Don't know Patterson on Properties. We wholesale real estate in the DMV area, and we purchase tax sales and tax liens in the good old state of Pennsylvania, then the Philadelphia, Harrisburg, and Reading, Pennsylvania, Allentown market. So our link is in the description. Check us out and go from there. But today, just going to be simple, to the point. Just knocking out a lot of content before my birthday week. And today, just going to be talking about different tax deductions that a landlord could possibly look into. I'm not giving out tax advice. This is just according to my research I've done. When it comes to your taxes, I'm not your tax person, so do your own research. But this is something you can look into, and this is the kind of conversation you can have with your certified tax professional. All right. Now, number one, distance travel. This is considered a tax deduction for landlords. If you have to travel long distances to check on your properties, the article states that you can deduct the cost of your travel expenses. Examples of deductible expenses include car mileage, airfare, and hotel costs. So something to look into. Number two, mortgage interest. If you didn't purchase your rental property outright, you probably have a mortgage, clearly. And if you do, you're paying interest to the bank. According to smart asset landlords can deduct their mortgage interest as a rental expense. This is well-known. Rental property tax deduction applies to all homeowners still. It's especially important for landlords to use because it's usually the biggest deduction that they can claim. And hey, it's something that I have claimed in my regards to my taxes, but like I said, everybody's taxes is different. So with it being a new year, it is tax season. So, it's something to look into. Number three, personal property taxes. And if you own any real estate in the state of Pennsylvania, you pay some serious personal property taxes, but that's why you can the cost of the houses is low, but the personal property taxes are high. Always find, no matter where you live at, they're going to find a way to make it even itself out, unless you're a millionaire or a billionaire. So, but anyways, number three, you may be required by your local government to pay personal property taxes, which majority of the time you can. I think the only state that doesn't do personal property taxes on their homes is in West Virginia, but you got to give somebody some incentive to want to live in the state of West Virginia, and I'll leave it at that. Especially since it was considered one of the most boring states in the country. But anyways, pay personal property taxes on equipment and furniture used for business purposes based on the value of the property. Most landlords are aware that they can depreciate their personal property, but did you know that you can depreciate personal items used and for your rental business at a faster rate? So it's something to definitely look into. And majority of the time, property management companies, they explain this stuff to people. And I hope you're utilizing a personal property management company with your rental properties, because it makes it so much easier. I just got a thing in my notification in my email from my property management company, which, makes life that much easier. I can just hand it over to my CPA and we go from there. All right. But anyways, the article gives an example talking about appliances, carpeting, and furniture can be depreciated over a 5-year period. Other items like fences, driveways can depreciate at a 15-year rate. If you can check to see which asset class your property falls into with the IRS. And that's why I said, always do your own research. Obviously, number four, it's repairs to the property. The IRS splits repairs into two types. Number one, improvements to the property, which increase the value. Or number two, returning things to their original condition or maintenance. And this is one thing that Bigger Pockets, which I need to start watching Bigger Pockets again, because I used to love listening to their content. They have a lot of great videos. Them and the Flip, man, I miss those guys. But anyways, Bigger Pockets notes that while improvements must be capitalized and deductions taken as depreciation over time, repairs and maintenance costs can be expensed in a single year. All right. Betterment, which does the change fix a defect in the property that existed before you bought it? Does it physically enlarge or enhance the property in any way? Adaptation, are you going to use the property in a new or different way than you originally intended when you purchased the property? Does the change rebuild the property to a like new condition? Have you already taken a loss for the damage? If you can answer yes to the above question, the article says, or your repairs fall into any of those categories that were mentioned above, it would be likely considered an improvement by the IRS, which means it needs to be appreciated. But as I always say, do your homework. Number five, local travel. Majority of the time, landlords, especially in today's world, real estate market, it's normal for landlords to live in a different state like I do when it comes to the rental properties, because you want to be able to buy a rental property that you can pay off cash money, or a rental property that has a very low mortgages. Like, for example, my rental properties mortgages are less than $400 a month. All right, they're $300 to $350 a month. All of them are within that range. And in today's world, if you can have a mortgage at that price, that's better than a freaking car payment. So I'm just saying, because it's in the state of Pennsylvania, and that's even with the overpriced taxes that you have to deal with. All right. So, anyways, so when it boils down to it, number one, actual expenses, or number two, IRS standard mileage rate. All right. Number six, legal fees and an eviction. Often landlords' worst nightmares, which more and more people are starting to see nowadays because the eviction moratorium has been lifted. Worst nightmares, eviction proceedings are extremely stressful and can bankrupt small rental businesses. If the worst happens and you are forced to evict or take legal action against a tenant. And a lot of times you can deduct court fees and attorney costs. However, even if one of these expenses can be deducted, such a financial hit could decimate your profits, and it can. So that's just one of the things. That's why you have to have revenue when it comes to, you have to have revenue when it comes to constant revenue and constant access to different ways to find access to capital when it comes to you owning a rental property, because it doesn't take much decimate your savings. It doesn't take much decimate your profits. All right. All it takes is that one bad tenant. A lot of times people don't realize that. All right. Anyways, smart move estimated that the total eviction related expenses averages about $3,500. How would your business fare with such a hefty fees? That's just what it is. Real estate, you can make a lot of money, but in real estate, you're gonna spend a lot of money. That's just one thing to take into consideration, even if you do, because it goes into, bolster your tenant screening process with detailed near instant background checks and, criminal checks, rental credit reports, and eviction history. That's what smart moves talking about. But you got to remember, at the end of the day, you can have the best tenant on the planet, but life sometimes a domestic violence situation can happen. An incident could happen with a child or a pet. They lose their job, which, that's where we're heading in this year. It's just becoming normal for more and more people to move back in with friends or parents or whomever, just to save money, because that's, we're in the tightening of the belt situation when it comes to more working people nowadays. So this is going to become more, normal, where even your average tenant who is on paper is a dream, they got the best credit score, but they fall on hard times. It's not your problem, because you're in the business to provide them with a great property, and their part of the deal is for them to try to take care of it and to definitely pay your rent on time. But in these times that we're living in now, who knows how this thing is going to end up? It's all up in the air at this point. Number 7, when it comes to a tax deduction, home office. If you use a dedicated space in your home to conduct rental business, it is a deductible expense, even if it's not a whole room. Home Guides points out that deductible space must be an area used exclusively for rental activity and used as primary meeting place for clients and customers. So that's just something to take into consideration. Money crashers also remind you that any equipment must be used exclusively for business. For instance, your work computer shouldn't be used to play games for other personal reasons. Yeah. Like if you have a job, do not conduct business at your job. You're just setting yourself up for failure. And if you need that job, you're really setting yourself up. So that's just something to take into consideration and just go from there, But yeah, they got into the weeds a little bit. There's several ways you can calculate a business portion of your house as an expense. In order to find a larger deduction, according to Money Crashers, you can calculate your space's square footage divided by the square footage of your entire house. If all the rooms in your house are roughly the same size, divide the number of rooms, your business space encompassed by the total number of rooms in the house. Use a prescribed rate multiplied by the allowable square footage used in the home. For 2021, the prescribed rate of $5 per square foot, with a maximum of 3,000 square feet. So that's just something to take into consideration. And once again, I'm not giving out tax advice. It's something to look into. If you educate yourself on the situation, in a sense, you should have less crazier questions and more intellectual questions, because that way you can have a dialogue with your tax professional and you can be able to go from there. I mean, really, at the end of the day, that's when you have a dialogue, a reasonable intellectual dialogue with anybody, when you're not just asking questions, you're asking questions with an answer all at the same time. It's like, hey, I look at it this way, but what is your perspective? A lot of times people ask me, what's my perspective? and I can give my perspective on something that I'm passionate about, I'm knowledgeable about, or something that I care about. But if I'm not passionate about it, I'm not knowledgeable about it, I don't care about it, I'm going to really say, like, a lot of times I'll get asked questions by my best friend, and he'll ask me stuff that I'm like, it doesn't really relate to me. So therefore I can't really have an opinion on it, because it doesn't, I don't think about that kind of stuff until it doesn't actually affect my day to day. We all have that thing. But anyways, number 8, wages for employees and independent contractors. If you hire a property manager, grounds maintenance workers, you can deduct their wages as a rental business expense. That's why I have the property management company. This also holds true for independent contractors like carpenters and electricians. So that's just something to take into consideration. Number 9, casualty losses. If anything happens to your property due to an unexpected event like natural disaster or fire, you can claim a total or partial property loss in your tax return. However, as Nolo points out, you can only claim losses to the extent that they aren't covered by insurance. So something to look into, something to take into consideration, to go from there. Number 10, depreciation is a deduction you can take for property and items that you own for over a year. The cost of qualifying items are deducted in small amounts over a set number of years. For example, rental buildings are depreciated over 27.5 years. This means that you can deduct about 1 in 27th of your rental property annually. So that's just something to look into. All right, number 11, beautiful insurance. According to Steadily, the on your rental are deductibles. This includes fire, theft, and flood insurance for your rental property, plus landlord liability insurance. If you have employees, you can also deduct the cost of their health and workers' compensation insurance. All right. And that's something that people don't talk about, how much having insurance for a rental property, having insurance when you have a business can give you a lot of tax deductibles, but like I said, consult the tax professionals. Don't just listen to a guy that's on the internet. Number 12, capital expenses. All right. Capital expenses are defined as purchases that are expected to last more than 1 year and generate revenue in the future. This might include equipment, land, or vehicles, but keep in mind, these are not the only capital expenses. Such as purchases are treated as investments by the IRS and must be deducted or capitalized over a number of years. Number 2, current expenses are the day-to-day operational expenses that keep your business running, such as rent and utilities. You can deduct 100% of current expenses from your gross rental income in the year they are incurred. So that's just something to take into consideration. Professional services. In addition, legal services mentioned above, other professional assistance can be deducted as well. Consulting a tax professional is not only advisable, but it's also deductible. That's another reason why I have a financial professional doing my taxes, because their services are expensive, but their services are deductible. So that is a beautiful thing. I could go into more depth, but I think that really just gets to the point right there. Number 14, operating expenses. Many items that you purchase for your rental property throughout the year can be classified as operating expenses, deducted in the year during which you purchased them. The IRS website defines these expenses as ordinary and necessary expenses for managing, conserving, and maintaining your rental property. Appropriate expenses that are generally accepted as necessary for rental business might include advertising, maintenance, utilities, and insurance. And number 15, last but not least, maintenance. The article says you might be tempted to put maintenance in the repairs category, but the ongoing upkeep of your property doesn't necessitate something before being broken. For example, landscaping and pool cleaning is done on a regular basis, even when there are no major issues. All right, so that's just something to take into consideration, family. Real talk. And you can also deduct any tools needed for cleaning or upkeep, such as lawnmowers, weed eaters, or paint sprayers. In some cases, it may be necessary to depreciate these tools, so check with a tax professionals if you have any doubts. All right, and according to HOA's website, you can even deduct homeowners association fees as a rental expense. And trust me, my rental property market, I have a lot of those. So I definitely do that. And, that's the beautiful thing of having a CPA. You can have that conversation, you can have that dialogue, and hey, hopefully everything works out in your favor. So on that note, hopefully you guys enjoyed the video. Let me know if you know of any other, because I don't know it all. If you know of any other tax deductions or breaks that one can get from being a landlord. All right. So on that note, do great 3 things. like, share, and subscribe. Have a great day. And as I always say, make money move so you're going to live real like a fool. Take care.